Hi there, and welcome to the first Abu Dhabi Bank Global Investment Outlook quarterly update. I'm thrilled to be joined by Neal Lindsay, Managing Director and Head of Real Estate Finance. Neal, thanks for joining me.
Pleasure.
So Neal, let's get stuck in. So the residential real estate market in the UAE has been performing extremely strong. That's not just rentals, it's not just purchasing. What's your thoughts on the outlook for that sector, and can the growth really be sustained?
Do you know what? I think it's a really fascinating market, and it's probably the market that touches all of us the most, right? Whether we're renters or homeowners or investors. And I think what's been really interesting is just the headline grabbing numbers, which are quite extraordinary. And if you look at, even the Q1 data for this year, which is mind-boggling to put it mildly, 82% increase in transactions year on year, on top of an already record 2021, where there were 52,000 transactions with a total capital value of 114 billion. So the numbers are extremely extraordinary, and I think if you look at Dubai in more detail, it has really outperformed relative to other markets. The particular parts of the market that are certainly grabbing the attention is the luxury end of the market, right? Mm-hmm. And we've seen a lot of focus and media attention on that super prime villas that you see on the Palm Jumeirah, but they only account for about 5% of total transaction volume. But interestingly, in the data that we've seen for this first quarter, there have been 32 homes with a capital value in excess of $10 million sold in the first quarter of the year, which is just extraordinary. And we thought last year was already an extraordinary number, and there was 93 properties sold with that kind of number. So it's been quite extraordinary. The one thing I would say is there continues to be a bit of a delta between the villa market and the apartment market. Where we've seen most price appreciation has been in the villa market, which is up about 20% year on year, versus the apartment market, which is languishing a little bit further behind at somewhere around 10% on average. There are other pockets where you will see outperformance. Ranches, Jumeirah Village Circle, places like that have had very high KPIs and very, very strong performance. I think the one thing that's also very interesting is that the new supply that's coming to the Dubai market, of which is about 40,000 units between now and the rest of the back end of the year, unfortunately the majority of those are going to be apartments, right? In fact, apartments account for about 80% of the total inventory in the market, when most people are really crying out for townhouses and villas. I think if developers had their way, they would prefer to be turning the dial a little bit more in the way of villas. But all angles suggest that the market is going to continue. I think growth will moderate in the second half. I know everybody's really fascinated to know if these levels of growth can be maintained. I think it's going to be challenging to maintain this level of momentum. That's why there's probably some moderation in sales appreciation expected in the second half of the year. I think in terms of Abu Dhabi, it's probably, slightly behind the Dubai market, and that's not unusual, right? It has a smaller inventory of housing. That said, the villa and apartment market there too has enjoyed some growth, albeit kind of more single-digit type growth levels. And I think the fact that their supply line is probably a little more constrained versus Dubai means that their market is probably not going to be subject to the same cyclicality and peaks and troughs that we would see in the Dubai market.
Okay. Lots to talk about villas and apartments, but let's move it over to the commercial side of things. Is it still the same similar growth as you've been mentioning, or is there a difference?
Yeah, there's a pretty stark difference. I think in fairness to the commercial market, I think it would be very difficult to keep tabs with the level of rate of growth that has been enjoyed in the residential market. That said, certain pockets of the commercial market are enjoying some fairly sustained and robust growth. Starting off, for instance, with hospitality, has really benefited strong leisure demand in Dubai in particular. Significant demand for beachfront and luxury hospitality, which has really benefited the market. And I think despite the fact that about 15,000 hotel keys are going to be added to the Dubai inventory this year, the KPIs suggest that occupancy is still going to run at about 80%, with average daily rates running at about $250. It will be interesting, I think, given the time of the year, to see if there's a bit of a post-Expo fallout, right, and see how much of that demand was supported by Expo-related activity. My sense of it is that, it will continue to grow, maybe on a more moderate basis, rather than, say, the exponential growth that's been enjoyed in the last period of time. But there is that concept, which I joked about in previous webinars, about revenge holidays, right? Mm-hmm. Where people have been so constrained and locked up in their homes or in their home countries, and they literally want to get out and spend money, and they're prepared to spend more money than they would ordinarily on, a luxury holiday experience. So that's certainly a beneficiary. And I think the other thing, which is always a great benchmark or barometer for how the market is performing, is look at what passenger numbers are with Emirates and Etihad and Abu Dhabi, and those numbers are trending very, very positively too. So, continuing influx of tourists to the market are going to help support that particular section of the market. I think office is probably, after a period of fairly muted growth over the last couple of years, is starting to show real signs of recovery, and we're seeing growing inquiries from international occupiers, particularly in the financial and technology space and the legal space, looking to take space in Dubai and Abu Dhabi, such that grade A rents are now on the rise for maybe the first time in about 6 to 12 months. So that all trends positively. I think probably the one thing that's also interesting is that we're not going to see the same level of growth sustained because there is a limited amount of supply, right? And I think what we're seeing amongst a lot of tenants now, and this is a function of trying to create a better workplace for employees, is there's a migration to grade A space and to better quality space and more amenity-rich space. And I think the grade B stock will suffer as a result of that. But I think the general sense of it is that the trends are all supporting continued growth of the office market. I think the only underperformer, and unfortunately continues to be a relative underperformer, is retail. And I've mentioned that, unfortunately, in the past, and I think there's a number of issues at play there. One is there was, pre-COVID issues of oversupply in the retail market. Consumer habits have changed somewhat to the transition to e-commerce. We don't have a fully fledged tourism market back in play as yet. The Chinese, who are not yet traveling, are a key component of the luxury end of the retail market. They're not here spending their money. But I think, generally speaking, it's going to trend a little bit better. I think we're starting to see signs of growth in some of the super regional malls in Dubai. Abu Dhabi doesn't quite have the same challenges. So, its growth will lag, as is normally the case. But I think overall, there's still a little bit to go in retail, but I think, trending in the right direction, but definitely running behind the other sectors of the market.
Okay. Very, very thorough roundup there. So let's go outside of the UAE, let's look more towards the international market. So what other asset classes within the real estate sphere would you say that investors should be keeping a sharp eye on?
Sure. I think, what's certainly true is that the overall market has sort of continued on its recovery journey generally, right? And if we look at the numbers that are available to us, global commercial real estate and volumes are up 34% year on year, right? So $282 billion of real estate transactions were completed in the first quarter of the year, which is very encouraging. And I also think that will be maintained, and that level of momentum will be maintained. I think in terms of what markets and what asset classes where we're seeing the activity, investment volumes in the Americas are up 47%. Europe, EMEA is up about 25%, with APAC up about 5%. So they're the markets that are attracting most of the capital from the investment community. I think, if we look at what asset classes within those geographies that are particularly in vogue, multifamily sector continues to be the star performer. It has been for the 6th consecutive quarter. So that will continue to be the case. What we're also seeing, and I think is very interesting, and continues to be very much an asset class within that whole living sector, is student accommodation. That's an asset class that both in the UK and the US we're seeing significant client interest in pursuing, and we're trying to help them with that particular journey. So that all augurs well. I think two interesting other points that kind of came from the data from the first quarter of the year is that the office market has made a good strong comeback, and this is on a global basis. It has outgrown industrial and logistics, which everybody had been talking about pretty much for the last 2 years. Everybody focused on trophy investments to a single let, Amazon on a long income, a 20-year lease.
Right.
We're starting to see a little bit of a migration away from that, and I think part of that is because there's a sense that values and prices are all fairly fully loaded at this stage, and there isn't, getting attractive returns off current price levels is going to be more challenging. And as a result, we've got clients looking to kind of go down the food chain or down or up the credit curve a little bit, you could argue, in an attempt to achieve super returns or superior returns. And that means maybe buying portfolios of logistics assets, some maybe with some regearing or leasing risk. But I think that's very encouraging. And then lastly, I guess from a global perspective, and I know I've mentioned that the retail sector in Dubai is struggling, but overall retail is making a bit of a global comeback. It has actually been if we look at that data for the first 4 months of the year, has shown growth of about 65%. which is higher than any of the other peer groups within the market. So that's, again, very strongly and very encouraging.
Yeah. If I could cast your mind back to the Global Investment Outlook for Q1, which was held at the Museum of the Future, you gave us a bit of an insight into or establishing a FAB US real estate fund. Could you divulge anything more? Is there any transparency or clarity there?
Sure. I guess the first thing is it remains a key and strategic work stream, a very important work stream for us, and we hope to be in a position to speak with clients in a more detailed fashion probably in Q4 this year. I think we continue to believe that there are very strong investment opportunities in the US. As a market, it continues to attract the most invested capital of any other region, and is arguably one of the most liquid real estate markets available for investors. I think what our investors will like about the fund when we get to speak to them about it is that it's going to create a unique opportunity to co-invest alongside best-in-class niche sector experts who are known to the bank, who have a proven track record of generating very attractive returns, and equally importantly have been trusted with some of the smartest institutional capital over the last 10 to 20 years. So I think that's going to be fantastic. I think, all of that taken together with the fact that it's going to be presented as a stable financing opportunity where FAB is providing the senior debt, and given our track record in delivering very unique and bespoke financing solutions for our clients in the US over the last 10 to 20 years, I think it will present itself as very much a sort of a seamless investment experience.
No, it sounds really interesting. So I'd like to hear more about it in the next Global
For
Investment
sure.
Outlook. So working from home, this hybrid model. Some people are going back to the office, some people are not. Talk to me a bit more about occupancy demand, and what's your thoughts on that?
Do you know what? That's probably one of the sectors that interests me the most, and I think we're all very keen to know what the new landscape is going to look like. I think there's a bunch of factors at play. Certainly investors and tenants are considering what level of investment is required in their buildings to maintain sustainability standards. So ESG is certainly a factor at play. I think more fundamentally and more importantly is what our employers need to do to get their employees to come back to the office. And I think the reality is they need to make it a more attractive workplace to want to come to, right? They need to invest, and we've seen that amongst a lot of clients in the market where they're retrofitting existing space, or they're moving to more amenity appropriate space to provide a better employee experience. I saw a recent survey that was conducted among employers, and the intent is certainly to get more employees back into the office, and I think H2 we will see that. But it's very geographic specific. I happened to be in Washington, D.C. a couple of weeks ago, and the streets were eerily quiet. And the very simple answer for that was, two of the most significant employers in that market, which are the federal government and the World Bank, had not mandated their employees to come back to work, right? So it was very, very quiet. You see retail, coffee shops closed on the corner street, but you come to a market like here, right? You go to the DIFC and you can see there's a real great energy and buzz about the place. I think in terms of how it will ultimately shake out, I think most international occupiers and corporates are going to adopt some form of hybrid, whether it's 3 days in or 2 days out, or some variant of that. And I think they need to do that if they want to retain talent. It very much feels like it is a sort of an employees market in terms of them making the decisions. And I think fundamentally employees, are motivated not just by what their pay packet is at the end of the month, but what kind of flexibility are they being afforded, what kind of environment are they working in, and what kind of employee experience they're being offered. The only caveat I'd probably add to that is if we find ourselves in some form of extended recession, right, and people are more concerned about protecting their jobs, I think you'll find a lot of people voluntarily returning to the workplace. I think, if you want to be safe, it's often better to be seen. So
yes, quite. And to end on that note, actually, talking about recession, I mean, taking into consideration the current landscape, classic question, what keeps you up at night?
Not much, thankfully. Probably the only thing that is a little bit of the unknown right now, and that people are talking about, is the rising interest rate environment. If that escalates a little out of control or becomes for a significantly extended period of time, you may start to see a little bit of distress in highly leveraged portfolios. I don't think it's going to massively impact the residential component of the market. I think it'll be more impactful in commercial real estate, where maybe borrowers have put more aggressive financings in place, and the cash flows of that asset are no longer sufficient to fund their interest obligations. That's probably the only thing that kind of gives me a little bit of concern. But I'm not an expert on the macro outlook, but my sense is that that's in control. But if it does slip or becomes elevated for an extended period of time, you might see a little bit of stress at that point.
Okay. Always super insightful, always super
Pleasure.
informative. Thank you so much, Neal.
No, my pleasure. Thank you.
Take care.